Basically, he was a physicist. Did nuclear fission, worked for, atomic nuclear plants. Brilliant, brilliant guy. One of his strategies that he used to end up using, he used to call it have a cigar. And what have a cigar meant was that the market's going to end up recovering on whichever big direction day it ended up having. So what ended up happening is that the market was down most of the day yesterday, right? Which means that a lot of the day players, okay, were short, okay, for a good chunk of that day. And what they have to end up doing is that they have to go home flat. Okay, there are many, many prop shops. Okay, and prop shops were proprietary traders that would all sit around in a shop, and you'd have to end up showing, okay, the prop shop manager your strategy, and if he deemed you worthy, okay, he'd end up giving some dollars to end up, okay, trading your system, and as you proved yourself over the months and years, you'd get more capital to end up trading, and most prop shops, okay, want to go home in cash every night. So that means if the market was down for most of the day, that means that most of these prop shops, and whether they were prop shops individuals or they've been replaced by computers and they're high frequency trading, most of them have been short for the day, right? Because they're momentum traders. They're always trying to push the market further in the direction that it's going. But they have to go home flat at night, which means that they have to end up actually then going and buying back their short shares. So many times from 1600 to 1615, you'll end up seeing this relief bounce, and it's a strategy that actually works extremely well. Rich used to call it have a cigar because at on the market on close or at 1600, what he would end up doing is that he would end up establishing his position, and then he would sit back, have a cigar, and by the time he was finished with his cigar, 10 minutes later, it would be time to close the trade. Okay. He was also a Pink Floyd fan, I guess. Anyway, those are the types of things that you want to end up seeing. You also have to end up realizing that there's certain levels that you'll want to end up paying, pretty close attention to. Let's go back another day because there was a good chart the day before, a good example. Tom, I don't have my questions open, so I don't know if there are anything.
Mark Mosley just asked about volatility skew charts and entering a broken wing butterfly, but nothing about the technical analysis stuff yet.
Okay. We can get into that a little bit later. One of the things that ended up happening, and I think it was while we were actually speaking in the morning. Yeah, it was. Okay. So what ends up happening is that when you end up seeing levels like this, okay, the 2360 level. Okay, here. The 2360 level looked like it was going to end up being a support level, and they kept trying to pierce it. Okay, they couldn't end up keeping it down over a full minute. Then they actually kept it down, for a minute and a half. But then when they broke it, they really ended up breaking it. So a lot of times you get a lot of, now remember, these are 1 minute. So I get a lot of these tails or pieces that may end up breaking it, and I call them crack and snaps. Many times what will end up happening is that this is a battle, right? This is a battle. And once we ended up getting through the level, you can see he ended up dropping a few points. And here again, the exact same thing happened, okay, where we ended up selling off. And let me see if I can go to the previous day if there was another day. Okay, another one here. Okay, this was you can see these levels here where there was definitely a battleground. Okay, that the market and by the way, sometimes they'll sit there and you'll see the battles where the bulls won't want to let it get below a certain point, the bears won't want to let it get above a certain point, and they'll just go back and forth, back and forth, back and forth. Sometimes it's going to be incredibly tight, like it was, during this 6-7 minute period where it's just going up and down a half a point. Other times it'll end up being wider. Okay, you can end up seeing here, though, as they ended up starting to go down here, right, there was a stair step. They went down, they kind of found the level at at 23.65 and a quarter. I'm sorry, 68 and a quarter. Then they got down to 68. They got down to 67. Right, but when 60s, right, 67. When they got down here to 67 and a half, and then they got down to 67, there was. Oh, sorry about that. You know, there were some bulls that just stepped in and said, enough. Okay, we're not going to be going down anymore. And you can see the big volume of the bar, and they just pushed it back up. Now, one of the things you have to end up realizing, and I've seen this happen quite frequently, especially not so much during the middle of the day. But sometimes bull markets seem to get tired when they are weak throughout the entire day. The tape does not look good for them, and then they're very strong into the close. What they're trying to do is they're trying to mask the closing price. Okay, this would happen all the time. Let me explain to you the way any of the brokers, okay, used to end up working, okay, for their institutional clients. Right now, these were the institutional brokers. These are the guys you want to end up talking to, right? Because they're the ones that would handle like orders from guys like Carl Icahn or some of the really really big investors. And they would all know one another. And what would end up happening is, a big guy like, a Baron Capital back then or an Icon, they'd end up giving an order, let's say, for, 5 million shares. And they would end up placing it throughout the street. They'd end up getting the order done. But what they would do is that they would end up saving maybe the last 100,000 shares. Last 50 to 100,000 shares. Back then, that was enough. Okay, and what they would end up doing in the last couple of minutes, they would just end up firing all of those orders, knowing full well that the market couldn't end up absorbing them all, and that it would drive the price up. Then at the end of the day, they'd be able to end up going to Carl Icahn and saying, "Look, our average price was 72, and the market closed at 72 and three quarters. What a great job I did." Yeah, it was them who ran it up a point and a half at the end of the day. And so that's, yeah, and you need to be able to see those spurt orders, because when those orders come in and then they stop, you have to realize this is a chess game between, some of the smartest, math and physics and econometrics minds in the world. It really is a very big game. And here has always been my point. If you guys haven't heard me say this, okay, this is probably the most important thing you can walk away with. Elephants leave footprints. If there is going to be a big buyer or a big seller or many big buyers in our case these days, right, and many big sellers, and trades do get very crowded, right, there aren't going to be able to be a bunch of big buyers, okay, without them leaving some type of footprint. What's their footprint? Their footprint is in the volume. Now, they know, right? They know every single trick in the book. So they'll know if you look at just green bars and red bars, okay, on something like this, they'll know how to end up masking their footprints. They'll know how to end up masking their footprints as much as they can in any type of price movement. They'll end up cracking, like 20-day moving averages to make you think they're going one way and then snap it back the other. But in the end, if they're big, they can't hide their volume footprint. It's there. It's there to look at. One of the things that the guys on the Sunday breakfast table used to always end up saying was that volume leads price. Okay, now back then it was true, right? Because you didn't have all of the high frequency guys. And if things ended up moving, you would end up seeing just more and more volume coming in, and the market makers or whoever was selling, if a big buyer was coming in, who's ever selling, they try to sell, and so before the market starts to actually move up, you're going to see an increase in volume at the current price levels before you get to the next level. Now, that used to end up being the case all of the time. But what ends up happening is that the market makers have learned to, fight a lot more like a Muhammad Ali did in some of those famous, Foreman Ali fights where he would do rope a dope. The market will end up moving back, okay, on lower volume where they don't want to end up fighting at that level, and they'll set up levels at a lower point where they can end up basically almost, if you read, Sun Tzu and the Art of War, you end up retreating to a point where you can fight. And there's all of these tactics that go on, but in the end, you can high. I mean, the high frequency guys do a ton of volume. Okay, and the problem is realizing what's just high frequency volume versus what's real purchasing power. And I'll tell you, it is hard. You can't end up seeing that easily. But if you keep looking at the volume, okay, and which way the market moves, it does give you hints. Okay, I do see some more questions coming in here. Is there a volume indicator available on TOS and okay? Some people love looking at volume weighted average, okay, VWAP, and here let me get rid of all of the studies and I'll show you. I will end up admitting I'm not a big VWAP guy. Not that I don't like it, that I've read a little bit up on it. I tried to use it. I did not give it, I am not an expert by any stretch. It's basically just counting up all of the volume at a given price. And I'm going to get to how I do that in a minute because I kind of do it the old-fashioned way. If I come over here.
And if there's people who want to participate, we're more than happy to promote you.
Yeah, if anybody has if you guys are, if anybody on there uses VWAP and likes it, or any other volume indicator.
I think Paul Demers, I thought I saw you here earlier. I remember in Training Group 2 this was a while ago, you had some program you were testing that it was using volume. Maybe you could share your thoughts.
Okay.
It's pretty interesting, it looked like. Go ahead.
All right, so VWAP, what it's doing is that it's kind of giving you an average and then a range of where the volume, most of the volume had taken place. And what's nice about it is that you can end up seeing where the volume is in a range. And here, let me make it. And so you can see what ends up happening is that when there's a ton of volume, it'll get wider, okay? And when volume ends up at the end of the day, right, because it's something that's cumulative throughout the day, okay? You can see that gets reset, okay, every night when the market's open at 1800. All of these times are Eastern times. And then what you'll end up seeing is the range get wider and wider throughout the day. Here's what I look at. Okay, I have something that I've set up. Not that I use this to be an active trader. Okay, but what I'll end up looking at is the following. Now, my bars are blue because I don't want to get confused and I don't want to overlap them. And I can kind of just end up seeing which way the days are moving. But what you see here, okay, is the volume. Now, I've had this open since I opened it this morning. The problem, okay, with this is that it doesn't give you the full volume at every price, okay? It's not like they're keeping track of this on their side. It's actually calculated on your desktop, okay? It's the desktop application that does this. So if you don't open this until, 5 minutes before the close, you're not going to see the whole day's volume. Okay, but what you will end up seeing is the volume since you've opened this up. Now, I opened it up before the market opened, this particular screen, and I just keep it on my trade active trader screen, and it doesn't take up one of my charts. And when I'll flip through, I'll take a look at it. Here's a great example of the day, right? If you take a look at what ended up happening when they tried to sell off, it was met with volume. What ended up happening, they couldn't sell it off anymore, it was met with volume. The sellers ended up giving up, okay, and then we kind of just floated up on lower volume. What happened when the bulls stepped in? We moved up again, okay. What does this end up telling me, this type of action? It tells me that given that today's a Fed announcement day, that there are guys that are trying to get long. Okay, this is a bullish type of tape. Okay, that you end up seeing during this time, and I believe what will end up happening is that after the Fed makes the announcement. Now, remember two things, right? The markets dislike uncertainty more than anything. This is almost certain that the market is going to end up raising, that the Fed's going to raise rates, and once that ends up happening, the market should end up digesting it well, and we should move higher from there. That's what the tape is telling you.
Right. Well, hi, Jim.
Hey, how's it going, Paul?
Not bad. So the last survey I read about that they took about, it's 100%.
Yeah.
All the bond traders are 100%.
Yeah.
So.
Yeah. We were at 90% before the great jobs number. And the jobs number, they were expecting 200. We came in at 235. Even the highest, estimates, or even, the highest street whisper numbers were only 230, and we came in at 235. And so we went from almost certain to totally certain, that the Fed's going to end up raising. So it's, many times what you could end up seeing too, and you kind of have to watch because the Fed, so many times, I don't know if you've seen this, Paul, after the announcement, many times, happens more so, I think, in currencies than anything else. You get these head fakes.
Absolutely.
Right? They'll start to move the market in one direction, to get all of the, I'm going to call them weaker hands or the trend-following computers to end up starting to get short when everybody else is going along. So it really is a bait-and-switch game that the high-frequency guys play with one another, and there's so many market participants who are trying to get into the game that, it's only the strongest survive. It is fiscal Darwinism.
Yeah, absolutely. What happens, these computers that are tout that they improve liquidity, when you look at the DOM and you look at the order flow, it disappears just before, when everybody needs it, it's all gone. And, what happens with the options trades, I don't know if people have noticed this, but, I watch especially the SPX trades, they widen the spreads right out because they have no clue.
They
so
don't.
Your P&Ls go all over the place while this is all going on. It's like, I'm rich, I'm poor, I'm rich, I'm poor. Oh, I'm broke. Oh, I'm rich again.
I got asked why don't, because I guess I don't know why this one's here. I thought I took all the numbers out. I found out how to do that once, and so I took all the numbers out because people used to never say, Jim, but it's really important to be able to end up seeing, what the size of the bids and the asks are. I'm like, no, it's not. It's all fake. It's all put up by computers, and the reason why those numbers look as big as they are is that there are so many high-frequency guys that are playing one another. But what ends up happening is that they'll just the numbers just disappear, right? They just disappear as soon as you need them.
I've seen it. Yeah. There's a piece of software that I'm eyeing to buy that is for trading, the ES, where they actually, what you see in TOS for bids and asks on the ES is very small compared to what's actually out there. And this shows the order book in its entirety. So you get to see those high-frequency traders putting in those fake orders and watching them.
Okay. Now, here's the way you can measure that, right? Think about this, guys. The high-frequency computers are going incredibly quick. As the markets move, their bids and their asks are going to end up changing very rapidly. I don't care how fast you are with your mouse, they're moving at light speed, and you're moving slower than a turtle, when it comes to how you measure things in times. They're
driving the Bugatti, and you're riding in your cart with your donkey.
Right. Yeah, and you don't realize how fast they go, because you have to understand. Tom, you'll know this one, right? What if fighter pilots have a saying, "Speed is life"?
Yeah, you don't want to get too slow in a fighter because that's your energy for turning.
That's your energy, right? And the enemy can catch up to you. It's right. Speed is life. It's also true in trading. Okay, you guys know the old joke about the two guys at the campfire with the bear in the woods, right? For those of you who
Oh,
don't know
yeah.
it, right? There are two guys. Okay, it's the evening. They're camping in the woods. They hear something rustling in the woods. Okay, one guy's looking into the woods, and he says to his friend, he goes, "Oh my God, I think there's a bear there." And his friend doesn't even look. He goes to end up putting on his sneakers. And the first guy says to him, he goes, "Why are you putting on your sneakers? You'll never be able to outrun a bear." I don't need to outrun the bear. I only need to outrun you. Okay.
Haven't you noticed, Jim, when you show up at the house, I'm wearing my sneakers?
You know something, Paul? Yes, I know. I never put two and two together. Thank you.
I actually, Tom, I have that piece of software, and I can show it whenever Jim sells.
Please.
Oh, yeah. Okay. There you go, Paul.
Let me find it here. It's hiding. Keep on talking till I get it.
Okay. Anyways, so what ends up happening with the high frequency guys? Okay, you have to end up realizing. If you want to understand how this works and you like an entertaining read, Flash Boys, okay, is a very, very, entertaining book that ends up telling you how a lot of this stuff works. Flash Boys end up basically explained how the high frequency traders ended up working. What they would end up doing is that they would end up putting up one order, okay? They'd put up an order for 100 shares. And you would end up going to the market that ended up having the biggest order. Now, when you came in and you end up trying to end up buying your 100 shares, they may end up, you put in your order, maybe you get filled, if you had 1,000 shares, you get filled on the first 100 or the first whatever, 50, okay, at some price. But now what's happened is your order's exposed, right? Your order's exposed. And they end up seeing it. Now, if you can't end up getting filled on that ECN, that exchange, your order will go to the next exchange. Well, the problem is that they have much faster sneakers, right? They're spending a couple of $1 million at minimum per month, okay, on their networks. They're going to end up getting to the next ECN. They're going to end up clearing out the orders, and then they're going to end up going and raising the price. Okay. The book is by Michael Lewis. Michael Lewis wrote a bunch of other things. His first one was Liar's Poker. If you've never read that one, that's a great, entertaining read. John Merriweather and, oh God, I forgot who the other guy was, over at Solomon. They used to end up playing Liar's Poker, okay, the traders did every single day. And one day, the chairman and the head of trading at Solomon, they played one hand of Liar's Poker for $1 million. Okay, Michael Lewis was a trainee on the desk. He ends up writing about how he ended up seeing it. And, oh, by the way, this was a funny one. One of the guys who worked at Solomon for many years ended up saying, it's bullshit. Michael Lewis wasn't there. I'm like, what do you mean? How do you know? He says, because he was a trainee and he was sitting next to the desk next to me. Okay, they were playing one floor up on the equity desk. We were on the bond desk over here. And so it's important to kind of know where things come from because it is a history of the market and understanding, those same tactics just at a bigger, faster level, but the same strategies are just there. Paul, I see your software's up. I'm sorry, I didn't notice that right away.
No, that's okay. There's a question that someone asked you. I don't know if you want to check the chat.
Okay, I didn't see it. I don't have my chat open easily here. I noticed wider spreads, with lower volume. You had mentioned that one already, right, Paul?
Right. It's the one after that, I think.
Yeah. Okay. But by the way, that's true also in any type of underlying. And all of this. The first book that I read on this is the So's Bandits. The bottom line on it is that when there's not a lot of volume, it isn't as easy for people to get in or out of trades. So therefore, if they buy something, they may be stuck with it for a longer period of time. Hence, they need to have more edge before they end up actually buying or selling. Okay. You also have to end up realizing that every time the SEC or the government does something to help. Right, I forgot I forgot how many words it is, but some of the scariest words in the English language. I'm from the government and I'm here to help. Um, what the government ended up making the markets do after 1987, because you could call up your broker and they just wouldn't answer the phone, was that they had to post, okay, for smaller orders. There was so many shares that they had to end up having, but they'd have to post orders on an electronic small order execution system called SOS. And what would end up happening is that when the markets would move quickly and the market makers who had to end up posting these things on an electronic system, they weren't able to move their electronic orders quick enough. So the SOS bandits would end up, watching the SOS systems, and they would send in their orders, and as soon as the market moved, many times they would be able to clip the market makers. And the market makers hated this, and it was called the SOS bandits, and they made a big thing about it. But the way they solved that was that they just made their spreads wider. Do you guys trade any spreads that has an electronic market? And the electronic market moves a little bit slower than the actual, the real inside market? Anybody trade the SPX? The exact same thing happens in the SPX because the pit, is where all of the really big orders go. The bid-ask spreads on the individual SPX strikes that we end up seeing are always wider than what they really end up having. And to this day, if you can end up getting your order cried out into the pit, you'll end up seeing that it's a much, much, much narrower bid-ask spread, and there are no capped in one lots distorting anything because you're getting a real market being made for you. And it'll be tight. It'll be very tight, where you'll see a couple of dollars a lot of times in a difference between a bid-ask spread on the SPX. When you get called into the pit, maybe it's 30 cents. In between 20 and, let's say, 50 cents almost all the time on the SPX, which is a relatively tight market. Jim, what should I consider from all of this? I want to open a butterfly, for example, to end up getting an order at a better price. The challenge, the challenge with understanding the price is that when you have a one lot to fill, your price discovery will be your price. When you end up having 500 to fill, I can throw away one lot, 5 lots to end up seeing where the pricing is. It will end up depending on it. A lot of people would prefer to end up trading let's say the SPY, because the SPY will only end up having, penny wide markets usually on every strike. But the problem is that it's 1/10 the price. So right there's a dime, right? But the markets are the market. There's no real pit. And so it really, Paul, you trade these things too. You've watched me trade for a long time. I don't know how to end up, you learned from watching me. You're probably better at answering this question than I do.
Well, I think that, I'm not sure that you use the overall market trends in analysis for better pricing on the butterfly. It's more of the placement of the butterfly. If I'm thinking, like, if I'm putting a trade on today and I'm watching the market and I'm thinking that we've topped out, I might put the butterfly a little lower if I think the market's weak and it's going down. So I might put the trade on 10 points lower than I normally would. So it's more of this helps for the setup more than the price. I don't, to get a better price is more, understanding the trade and the butterfly pricing to know historically where you are in the market.
Paul, I'm going to share the story when we first, well, not before we met in person, but when we first met in on the Monday Florida trading group. Okay. Paul ended up asking a couple of questions about a butterfly that my old trading partner, Stephen Channon, and well, actually, it was a Jeep. It was probably the closest thing to it that you guys may end up seeing was the Weirdor, okay, that Amy ends up trading. It was a trade that Dan Harvey and Stephen and I, we all traded very early on. Dan Harvey taught it. Stephen and I didn't. And we used to end up trading this. And Paul ended up trading a version of it that we used to end up going over in our Monday trading group. And he was going through back testing, and he started to end up asking questions. And as he was going through this stuff, I would question, what he was presenting. I was like, well, how do you know that's a good price? I've back tested it, okay, and in the 130, okay, months that I've traded this thing, this is in the best 5% of the price that I've ever got. I was like, wow, okay, that's a pretty good answer. And one of the things that Paul is saying here is that you can't know. Okay, you can determine what price is for a good butterfly in one of two ways. Okay, if you don't know the underlying and how wide your trade is, and you don't have a lot of familiarity with it, you can end up figuring it out by how steep the put skew is and what the level of IV is. Paul, is this the one that you had just recently done?
Yes.
Okay.
So this is how I find out where the butterfly pricing is historically based on and comparing it to what it is today. The red line is today's price. The green line is the average from the beginning of 2011 till February of 2017. And these are all of the different pricing. So, what happens is once it's important to track your data as you go along, what you pay as you're trading it, keep track of what you're paying for it. So you have an understanding where in this realm you are putting the trade on. Now, it doesn't mean, the caveat here is it doesn't mean that putting a trade on up here will not make money, because it will. Because if you look back here in 2013 and 14, if I only included that data, all these lines would be up here. So, this pricing that we're seeing has gotten, this is for an iron, so this is collecting more money. So I want, I prefer to have this red line down here. That's a good deal. But unless you know what the historic prices are, you don't understand if you're getting a reasonable price or not. And sometimes if you think you're paying a high price and you put the trade on, you'll still make the same amount of money, because you may end up, we may be, we're trending up. So we may be going to get back into this scenario when it's trading up in here for a long period of time. And back here, 2013 and 14 was some pretty good trading. There was a lot of money made in this time frame. Even with the prices, these irons, the prices were lower on the irons than they are today.
Now, one of the things that ends up happening there, right, is that when the prices are higher, that's because the volatilities are lower and the market's probably not going to move as much.
Correct. And that's the other thing that I don't know that a lot, people take that into consideration enough, that when the vols are low, that means the market's not moving around much.
Let me share with you some more Sunday morning breakfast wisdom. This is one that I've heard a bunch of times. It's not whether things are good or bad, it's whether they're getting better or worse.
Right. Right. This is the ES chart of the software. So and this is very short term, but whether when the volatility is low, you can make money as long as the market's doing this, channeling in a range. What hurts is when, in all our trades, is when we go from this channeling to doing that, whether it's up or down. So the only issue is when it's a low volatility, this becomes very painful when it's on the downside. But while we're trending, you can, I've traded a lot with the VIX at 12, and the trades have done okay. It's when the problems become the VIX goes from 12 to 16, and you're in the trade. So somebody had asked about volume profiling, and this is, to me, the ultimate piece of software for volume profiling.
And what is that software, Paul?
It's called Investor RT. And this is kind of a composite. This is a daily 15-minute chart, so I can look back at history. You can see, I squish it up here a little bit. And this goes back to, gosh, I'm thinking 2010. So this area here is the volume profile for the whole bunch of data. So when I squish it really tight, you can see all the volume since 2010. So depending upon what your time frame is, it's helpful to just see what the market direction. And yes, I think volume profiling is worth looking at when you're trying to figure out support and resistance. I don't think it's the end-all, be-all. But this, you look up here. We spent some time up here. It's got low. These are all the high volume nodes. The low volume, and there's a lot of stuff on YouTube explaining how this all works. But this is fairly accurate. It's kind of amazing once you understand the auction principle. So I use this for my intraday trading when I'm putting a trade on or when I'm adjusting a trade or taking it off. I want to see what I'm thinking the market, where it may go and stop and kind of guess. So right now we're trading in here. If, there's a lot of empty space up here that they will probably come back up and test to see if anybody likes these prices. If not, we'll end up down. It likes these prices, so it's going to gravitate to these high spots. It's going to reject the low spots. So you use that as a tool intraday to see where all the participants and where they're going to move. So I like this tool a lot. It's not cheap to use just as it'll do everything. It's not just futures. You can put Apple or any stock in there, and it'll give you a profile for it. And the charting is phenomenal. What it can do. If you're into charting and building charts, it's got code. You can build your own indicators. This is a composite that I can build. I built this composite while you were watching to include all of these days. So now I can see where all the money's flowed inside this range to help make a decision. And basically this is to help get a better fills, a better exits on my trade when I'm trying to close it, because I need the market to be going up. And yes, TOS has a profile. It's nothing like this. It's archaic compared to this. What this can do. You can't put if you look, there's a profile for each day. Then I put a profile in for these days. Then I have a profile for the whole graph. You can't do that in TOS. You can just put
TOS will only do the profile for the period of time that you have it open.
That's correct. For the
and
graph.
it resets every day.
Yep. And the other thing is TOS, remember with ES futures, TOS bundles the ticks into 1 minute. This is tick by tick data. That's this thing is storing. So this is by the tick, and it's not group. I think IB does the same thing. Most of them do. So this is pure day trading ES futures software, and it's overkill for what we're looking for. Wednesday, how far do I know this is going? Nobody knows. Maybe Goldman knows. But that's the other problem. Here's the other problem. I'll stop sharing because I don't want to take up the whole screen. So one of the issues I have with trying to rely a lot on indicators and to get a feel for where the market's going. When you're trading futures, guy that I talked to about doing it calls it the hard right edge. You're trading up against the hard right edge of the graph. What's beyond that, nobody knows. It's a 50-50 shot whether it's going up or down. It doesn't matter what the indicators are saying because the indicators only see what's on the left side of the graph. And, we can all see what's on the left side of the graph. If we could go back and trade what's on the left side of the graph, we'd all be rich. All you're going to do is make your best guesstimate based on experience or history or probabilities of what the market's going to do and where it's going to go. And you judge you trade based on the probabilities, and you have to set up your trade and make your adjustments and look at your trade that you have a high probability of being at least 50% wrong. So what happens if you're wrong? As long as you make your adjustments and you look at your trade and say, if I'm wrong, it'll do this. This is where I'm going to get hurt. And if I'm right, I'm going to be okay. Then that's, basic, very simple. But the trend, Steve Channon made this comment a long time ago in that Florida trading group. He said, you take the chart, you print out this, a 2-year chart, and you stick it on the wall, and you stand back and squint your eyes, and if it goes from bottom left to top right, the market's going up. I heard that, it was like, it's brilliant. The worst thing you can do is listen to anybody else, me included. You have to look at the thing and make your own decisions. Oh, Teddy, the gap. Oh, the gap. Yeah. There's no way to tell that. That's one of those 50-50 deals. When you went to bed on Tuesday night, you had no idea that was going to happen. And I don't think there's any way that anybody can predict that.
Yeah, I don't think so. That's a really, really hard thing to end up doing. It's because you just don't know, right? You just don't know which way the market's going to end up going, and you do, the best you can, but it's not an easy thing.
Right. I mean, who knew, this market is so news-driven. Is the computers aren't just out there trading. They've got computers that go out and scan the universe through the internet for every headline in every blog, newspaper, Twitter account, Facebook account, and they're looking for trigger words that they've come up with. And they use that to help them trade.
Oh, but by the way, in some computers, they don't even get that information and then somebody analyzes it. They've actually written the analysis. They codified, right? They put into code, okay, their analysis if for certain words, and the computers will actually trade as the news comes out.
Right. I remember this, watching this one stock afterwards. Some news came out that about their earnings. Well, the news headline wasn't correct. The headline, their earnings were terrible, and the way the headline was worded made it sound like the earnings were great. The stock ran up 10% before human beings actually read the article and shut the computers off. So, this is what we're playing against. So you just, the old. I like technical analysis a lot, and it does work to a degree. You still have to trade for the outliers.
I ended up doing some consulting work, financial consulting work, not trading consulting work, for a high-frequency trading firm. And I can't tell you anything about it, but I will tell you this about it, because this was a very. Their CFO tried to end up explaining to this bunch of consultants that were going to be helping them on the kickoff of the project. He tried to explain what high-frequency traders do. And the big thing he kept doing is he kept saying, we provide liquidity, right? That's their big thing. We provide liquidity. And when we were done, we were talking, okay, and it was just he and I. Nobody else was there, over a cup of coffee. And I said, yes, you do, except for when I really need it. When I really need it, you're nowhere to be found. And he put his index finger up to his lips and he went, shh. And so it's, the term that we all use is that they kick the plug out of the wall, meaning that they just turn the computers off. And when things get to be uncertain, they can't trade. Now, that's the same thing as what happens with the markets. When they're moving very fast, the markets are very wide, and now their speed is not going to be enough to allow them to get in and out quick enough with any certainty. They're not interested in trading in uncertainty. When computer-based trading first came out and the algos and the high-frequency trading firms, do you guys remember? I mean, Paul, this had to be, 2007, 2008. There would be these trading firms that would announce that they didn't have a single losing trading day in an entire quarter. I was like, how do you do that? Well, you do it because the thing is that they basically almost had guaranteed trades because they knew that they were going to be buying and selling within, milliseconds of one another. And they were basically, doing not arbitrage, but I'll call it asynchronous arbitrage. Just buying a split second, okay, different than they were selling, and they knew where the prices were. And so it's you can't, right? I look at it this way. There's certain things that you can't do anymore. You can't scalp. Okay, anybody who used to make a living scalping, okay, it's gone. The computers are just way too fast. Trying to intraday swing trade is a very, very difficult thing also. Very few people can end up doing that well. I know a couple of people that make a living doing that, but I can tell you that the ranks of those people have probably been demolished by 80, 90%, okay, over the last decade. I kind of take a look at the one area where we do have edge is that options, while there's a lot of math in it, don't forget what drives options. I mean, what's the nickname of the VIX, right? The fear indicator. You're trading in a human emotion. And so our movement, okay, ends up being something that the computers can't totally predict. We understand our edge. We understand how to do risk management. If you ever look at, and Tom, you and I need to talk about this. I had gotten asked, is there any easy way to compare all of the different trading strategies? that we end up offering. And I went through all of them and realized that, every one of them is in, it's 80 to 90 plus percent. Okay, we're winning all of our trades. Everyone has a bigger average winning trade than an average losing trade. Every single one of them. Um, and so you end up taking a look at where's your edge and how do you end up doing that. And it really comes down to, and Paul, you know this. It's not a perfect set of rules. It's more a set of guidelines, knowing when things when you can press the gas and when you need to end up being more conservative.
Right.
And knowing when things are looking a little risky that you need to protect yourself. I mean, those are the biggest things.
Right. I think that the biggest thing is, for me to mention, is, I don't trade a lot of different strategies at one time. I'll stick to one or two, and so that I get to know them very well. And that's part of the risk management, is understanding how the trade works, so you know its weaknesses. So if you're in a position where the trade is you're going to put a trade on, and it's not at the optimum spot, and you don't know that unless you trade that trade all the time, because the way you find out where the weakness is by losing money, and typically you don't forget that. So it's there's a lot to doing the trade, just throwing a trade on. I was trained, you just put the trade on. You put the same trade on every time, and you just manage the trade. And that's not the way it works to be successful. You have to understand a little bit about where you think the market's going, what the volatility is, how the trade looks when you set it up. I go a lot by my gut. If I'm feeling uncomfortable, I'm doing something. I don't care what anybody else is saying. I'm making some kind of change. Somebody had asked, I just wanted to make, Teddy made a comment about, he sees weird contract sizes in the bid and the ask, like 31, 29, 43. It's my guesstimate that those numbers go to different brokers. When they're in charge of the bid and the ask, they put that size in so all the other brokers know who's running the book at the time.
The way it used to work, and there were four, Goldman, Timber Hill, Citadel, and I think Susquehanna. I'm probably wrong on them, but they're the ones that come to mind. But there were four main market makers, and they used to take turns out who was going to be the lead specialist, if you will, who would end up maintaining the book. And they had different sizes, like Paul would end up saying. Now, I don't remember which one it is, so I'm just giving you a hypothetical. So it might have been that 51 contracts were Citadel. And so that whenever you saw 51 by 51 on the size, you knew that was Citadel, and it was their turn to end up being market maker. As soon as you saw something that wasn't 51 on it, and I pulled that up, Paul, if you just pull up the SPX, and I see, a bunch of 51 by 50s.
Yeah,
okay.
I do too.
Right. And so those 51 by 50s, those are the pure market makers. Now, if we end up going down there and we see a 51 by 1, okay, that's that's Captain One Lot going and trying to sell, right? Because it's 51 by 1, and so he's on the sell side. That's Captain One Lot trying to get rid of one of their contracts that they end up owning. Okay. And so when you take a look at the difference between the bid and the ask, and you'll see that the difference between the bid and the ask will be relatively constant. Now, of course, they're going to end up changing. You're not going to have let's say a 20-cent wide bid ask, okay, when you're trading at, 20 by, it's not even 20 by, I'm looking in the front month and I'm looking like 20 by 70, 35 by 70, 25 by 80 cents. You're going to see those types of spreads where there may be 50 cents. Now, if you go deep into the money, it's not going to be 50 cents anymore. It's going to be dollars. It's going to, you go deep enough in the money, it's going to be like $4 wide. And that's because, they don't want to get caught, okay? Because remember, when something's so deep in the money and the deltas are that high in it, it moves, the intrinsic value moves dollar for it. So you kind of take a look and you can see what's going on here. Is it just market makers moving this? Do you have a lot of different size quantities? That's going to end up being, kind of, again, more hints of who's doing what in the market. Okay? And that's why, what you guys ever notice this? You ever notice if you have any strikes in the money, your P&Ls have much wider swings? Right? Doesn't that always happen? The reason why that happens is because you have intrinsic value in there, so therefore the market makers need to end up keeping the markets wider. And so when, a captain one lot comes in or they have to start to move things, they move them in bigger chunks. Okay, and you have a bigger difference, okay, between your bid-ask spread.
And you have the same problem when you're buying an out-of-the-money put butterfly for like 30 cents. Because if you think about it, if they move the mid price of one of the strikes 10 cents, that has a dramatic impact on your P&L because you've only paid 30 cents for the thing. And it could go easily to 50 cents intraday while they're fiddling around.
Or how about this one, Paul? You ever see this happen? It'll be 30 cents, but you'll end up taking a look on your Thinkorswim, and the natural price might be $1, but the mid price is 30.
Right.
Okay. Think about that for a second. The mid price is 30, but it can't go below 0. But yet the mid price is in half of what the natural is. So that means that if you take a look at it, if you were looking at the other side, instead of paying $1, what would be it might end up being 70 cents. I mean, it might be minus 40 cents. Now, nobody's going to sell you a butterfly for 0 or minus any cents.
Right.
Right. And so, I mean, right there, that kind of ends up telling you, okay, yeah, I understand that the bid-ask spreads are wider than could ever possibly end up happening sometimes. Right? Does that make sense to everybody?
It does. And we're a little bit over an hour and 15 minutes, so maybe this is a good time to wrap it up.
Sure.
What do you think?
Any last questions that we didn't get to?
I think you pretty much covered it.
Okay. Paul, I'm sorry. You were about to say something.
Oh, no. Well, I was going to go over how I exit intraday. I didn't know. We can do that another time if you want. Or enter a trade. Because this is where, to me, it becomes, if you want to get better fills, better pricing. It all comes down to understanding how this is working. I
think that's such an important topic, Paul. Maybe we could end up.
Why don't we go a few more minutes and do that? Yeah.
Okay. So let me show my poor trades here. So here's that one's a little tough. Let's do the rut. That's brand new. I haven't messed it up yet. So here is a rut trade I have on. So this is what this is an M3 style trade. So I just wanted to point this out because when you're putting the butterfly on, just take a look at the T0 line. And we all know that TOS has a problem. So, you see how it's sloping down. So if you put it on right now and the market's going down, you're immediately going to make money. If you put it on, the market goes up, you're going to lose money. That becomes interesting when you are going to put the trade on.
I'm not seeing your screen. Tom, are you seeing your screen?
Hang on. I guess I stopped sharing.
No, I think you stopped sharing and need to reshare.
Oh, okay.
There we go. It's loading now. There it is.
Okay. So, here's the basic butterfly. Now, I put my trades on. I do the butterfly and then do the call. Especially on this, it's small. So my timing on entry on this is and exit is kind of important. So typically, if I'm trying to enter the butterfly and it's going down, the market starts to go down, I'm going to slowly get worse and worse pricing and not get a fill at the mid price. If the market's going up and you are putting the trade on, you will get it filled at the mid or maybe better. But typically in this size move, they'll hit you at the mid because you are going to lose money. They're kind of guaranteed that they're going to make some money on it. What happens when you do that particular trade and I have to buy the call, the worst thing that I want to do is have the butterfly on here and be chasing the market up for an in-the-money long call because you will pay up and it costs a lot of money. So what I've actually discovered is I put the flies on when the market's going down because I want the call cheaper. So you have to understand how your trade works, all the bits and pieces to it, to figure out how you want to try and time the market. Now, nobody always gets it right, but it does give you a little bit of an edge if you understand how the particular trade you have works to get filled at a better price and actually get filled. Because, you could, SPX, you can sometimes offer them 30 cents, 40 cents, and they still won't fill you. But this will, knowing this stuff helps me get better fills, better prices, not get in trouble as much. And so I do the opposite. I fill the flies and put the calls on. I like doing them here. It's kind of opposite because I'll end up collecting less money for the fly. And I want to take them off when the market's going up. So I sell the fly, if I'm doing a regular fly, for less money because the market's running away from it. But I've had times where I've put the deep in the money call price at the ask and had it fill at the ask. And I prefer to get the call filled at the mid or the ask. If you're doing a 60, 70 delta call that you're trying to sell, you certainly don't want to be chasing the market down because the spreads are so wide. So I don't know if that's explains it well enough, but most of this has to do this is for this style trade. If you're doing a road trip, my guess is the market needs to be quiet. You want an area where the market's kind of quiet. Market makers have settled the prices down because they know the market's not moving around. But when you're putting pieces on that are directional, it does make a big difference. So this is something that it's worth understanding how it works and watching it so you get a feel for it. Took me a while to get this comfortable being able to look at the chart and decide, okay, now I want to put the fly on. And it doesn't end up being so much about getting the best price for the fly. It's what the whole package is going to end up looking like.
Paul, not only do I like doing it that way, but sometimes when I get the fly on first and the market is coming down, now there's no pressure whatsoever to end up buying that put, right? Because you can end up waiting for them to come to you. You can end up getting it done on your side of the mid price.
Right. I mean, what happens through experience, I found that a couple of reasons why I'm okay with getting less money for the fly and getting the call cheap. The call is going to decay in price anyways.
Yes.
While if you get, 20 cents less, if you have to pay 20 cents more for a regular put fly or 30 cents more, that put fly has got theta in it. That you're going to make money on that fly even if you pay more for it. Where if you pay more for that call, you're just going to continually lose money on it. It just means you're going to lose more.
Right.
So, it becomes a whole strategy of what you're trading and how the fills work and how best to get it filled. Because the market makers are only going to trade with you if they have some kind of edge to be able to hedge the position and make some money. If they can't hedge that trade off and make a couple of bucks on it, they're not going to do it.
Right. That's exactly right. And there's a bunch of different ways. I'm thinking, Tom, maybe we can ask other folks that, have kind of built their ritual on how to get trades on and off and how they end up getting their pricing. I think that, how to end up getting good pricing on fills is probably a great separate topic that we should do a whole roundtable on.
Yeah, that's a great idea.
And so, Paul, we will talk. We can talk about, different techniques. We already have, but we'll talk about which ones we end through. And anybody, an invitation to everybody, if you'd like to end up talking about, by the way, not just, hey, I have great times when this is the way I get good pricing, but if you want to end up talking or have questions about, hey, how come I get bad pricing all the time? That's also a good topic to talk about because it's,
sure.
It's about how we're more efficient.
I had an 8th grade teacher that said the questions you remember from a test are the ones you got wrong. So the times we get bad pricings are usually the ones that stick in our mind.
Battle of Hastings, 1066.
That was the only question.
That was the only question. I got a 99 on my high school regents in history, and that was the one question I got wrong. I'd get a 1 if I had to take the test today.
All right, with that, I think this is a good time to stop. So thanks, Jim. Thanks, Paul. Thanks, everyone, for sticking with us. Really appreciate it.
No problem.
Thank you, everyone.
All right, we'll see you next time.
Bye-bye.